Welcome to the True Wealth Project, where we talk business, real estate, and lifestyle on your way to building a wealthy life for generations to come. I'm your host, Sam Khairi, and I hope you enjoy the show. Hey everyone, Sam Khairi here with another episode of the True Wealth Project. I'm super excited for our guest today, Luc D'Abreau. Hopefully I pronounced that correctly, but Luc's been he's agreed to be on our show, and he's got, just knowing him for a brief period of time and reading some of the stuff he's done, he's amazing, and I can't wait to talk to him here and share his story with you guys. So, Luke, appreciate you coming up. I'm looking forward to this, man.
We're both in Yona Weiss's challenge on LinkedIn. I was trying to remember what the exact hashtag was that he was using this time. I don't remember exactly, but
CRE. I think this time. I mean, we're gonna start running out of hashtags for.
I know. Yeah, but we were we were in the same group and we met there, and then you had a post about being a podcaster and starting it all up, and I was like, I remember what it was like when we first started ours and how much work goes into it, and so I was like, okay, let's do this, and I'm more than happy to jump on.
Yeah, awesome, man. Thank you. I really appreciate that. And I like I said, the brief period of time that I've known you and kind of reading your content and just talking to you briefly, it's like I found the right guy for the podcast, so I can't wait to share your story. So, all right, man, let's get into it. We're going to talk about the state of multifamily, right? But before I get into that, Luke, just briefly for our listeners, I know you're a GP on over 200 units of multifamily. You guys are also invested passively in a bunch of other deals as well. You're originally from California, which is awesome because I'm also from California, but you made the mistake of, I think, moving to Texas. But I won't hold that against you. But yeah, you definitely want to talk about that as well. But again, just thank you again. And if you could give us a little more detail on your background, kind of what you guys are doing and how you got into real estate and multifamily in general, that'd be amazing.
In Southern California, and I ended up doing the whole thing of going to college, and I went to grad school, and I studied engineering in grad school, and I ended up living in LA for 9 years after finishing school. And it's funny because as soon as I started working, it was maybe 2 months after I finished grad school and I was really working, I was like, yeah, it's something that didn't feel right. And at that time I was 23. It's hard to put my finger on it, but ultimately what it boiled down to was that I just didn't want to end up being my boss, in 20 years. Like, I didn't want that. And I think I had been exposed to real estate. I've been exposed to entrepreneurship a few years earlier when I was in high school. My dad was kind of like a serial entrepreneur in a lot of ways. And so it was very normal for me and my brother to always kind of be starting something or doing something. Like, I tutored kids in high school. I sold stuff on eBay. My brother grew crops and sold them. He burned CDs and would sell them. It's like, there's always kind of something that we were working on and doing.
That's awesome.
It was just really natural for us just because of how my dad was. He was very entrepreneurial minded. And so that was just kind of by osmosis, that was the case for us. And so, my parents also, how real estate comes into it is that they had a primary residence that I was in for a few years, the first few years of my life, and they ended up renting that out. And then when I was 18, they ended up moving, and they actually held on to that other residence and they rented it out. And I kind of saw that power of real estate, but I also saw what didn't work in certain ways with real estate. And so that was always in the back of my mind. And so, to fast forward and loop it back around to when I was 23, I read Rich Dad Poor Dad like so many people did. And it just kind of crystallized and put a lot of things down on paper that I knew to be true, that I kind of knew of these truths because I had witnessed it and kind of felt it and seen it and grown up with it. But I just hadn't seen it put down anywhere before, Sam. And so, I kind of dabbled and looked at different ways to invest. Like, some of it was like, well, maybe I moved to Arizona. My brother and I were looking to trying to buy a fourplex in Southern California, which is difficult because of, I'm in my early 20s. I don't have any money. And it's like, how am I going to get a down payment? So I'm going through all these different things. And long story short, I invested passively. I had the opportunity to, I believe when I was 28 or so, now I'm 34 for context. And I invested in a deal. My then girlfriend, now wife, invested alongside me in a second deal, which is crazy looking back on it, to invest with somebody you're dating for a couple of years,
right.
But it's worked out. And yeah, and then, as you alluded to, we became GPs, um, in no small part to the fact that we ended up deciding to move into the markets that we're investing in here in Central Texas. And so we've been here for about coming up on 2.5 years now, to grow from there. So, because of the cost of living difference, it's afforded us the opportunity. For me, I still have a full-time W-2 day job and end up doing Make It Rain, our company's Make It Rain Capital, and do that work evenings, weekends when I have spare time. And my wife just focuses on the business full time. And so, yeah, it's been a blessing for sure, and
Yeah,
very,
that's
really, really grateful for the opportunity that we've had, but also like what we've been able to create as well.
Dude, that's awesome, man. I mean, just I think you can attest to this as well. I mean, I'm personally seeing, and I appreciate you kind of giving some, age ranges, right? Of like when we, a lot of us are different times in our lives when, like, that light bulb goes off, right? A lot of us, we have people around us that are successful and have, whether investments or, that rich uncle everyone kind of refers to, right? But it's like, it's never us. We never never pictured ourselves becoming that rich uncle that always just buys assets. But yeah, dude, it's amazing at such a young age. You at least were able to, like, switch on and be able to, like, hey, this is not what I'm looking for. This is not what I want to do for the long term, and be able to make that kind of transition, and get on the track, right? I mean, it's not always going to be easy. It's never realistic, especially it's not a get rich quick scheme overnight. But just the fact that you were able to do that and make that switch, switch your mindset, and get on that track is amazing, man. Kudos to
Yeah.
you.
Yeah, no, I appreciate it. And really it was that when I've always been like very goal oriented and very focused and hardworking, right? That's just kind of been in my nature. And part of that was just my parents' example as well. But I kind of had like agency and ownership over my academic career, if you want to call it that, when I was an undergrad, and there were different challenges that I experienced. Just like trying to graduate in 4 years, doing an engineering degree, like it was difficult, and then going to grad school. And I kind of had like this ownership, and I've kind of thought, okay, I'm going to own my own firm because that's, of course, why wouldn't I? That's the
Right.
natural progression. This is the
Yeah.
next step, right? And then I get out there and I'm like, engineers don't make any money. Like there's no equity that gets built. It's a
Yeah.
service based business, right? And there's no hard tangible asset. It's a bunch of IP. And I was like, and these were, I wasn't thinking these exact things at the time, however many years ago, but it just didn't make. I was like, man, this isn't what I was thinking when I finished school. I thought everything was going to be great, and now I'm like, I kind of had a bad taste in my mouth.
Yeah, that's amazing. I think a lot of us just being a professional, coming out of school and becoming a professional and being programmed to, now it's time to go get that job, buy that house, have that family, upgrade your cars, upgrade your house every so often, and that's life, right? But dude, kudos to you guys. I mean, I can't say enough great things about how you guys have been able to kind of accomplish what, at least get on the path of what most people only dream of. So that's pretty cool. I do want to get into some questions because I know you guys are pretty active in the market, and being in the markets that you guys are investing in, which I think is awesome, right? Just first question, right? What how are you guys approaching deals? How are you guys approaching the market today, right? I mean, if you want to just give us a quick, what's gone through the market. I mean, the interest rates have gone up, and how are some things different? And what are you guys doing to approach what's been going on?
So like now there's a lot less deal flow than there was a year ago. Like for context, we're recording this in spring-ish of 2023. Like a year ago, there was a lot more deal flow. 2 years ago, there was a bunch of deal flow. And so we're more intentional about kind of continuing to build and foster those relationships that we have with brokers. Like that's one piece, is just being communicative about where we're landing, because the brokers kind of hold the keys of the castle in multifamily, at least, and they're the ones who you're really the one selling yourself to them, even though they're representing the seller.
Right.
And so that's been a big piece for sure. I mean, the other thing as well, Sam, is really trying to nail down debt. I mean, which is difficult, and just being as realistic as possible. I think some people in some ways are conservative with their underwriting, which I think is good. It's good to be conservative in some aspects and some metrics, and then others, it's like you want to be as realistic as possible. And something like that is specifically with the financing right now. You know, it's gotten easier, I would say. You know, the part of last year was definitely more difficult to get financing locked down. Now it's getting easier to at least get high level feedback from a broker or from somebody who's on the debt side. But that's one way that we're approaching it. The other thing too is like we've kind of cut our teeth as syndicators. That's how I came in as a passive investor, and the way we've built our business is off of the syndication model, which works well, I think. But what we kind of saw that there were like cracks in it, right? There are retail investors like yourself, like myself, and when they start hearing the R word on TV and recession is going around, you
Yeah.
know, people tighten up, and rightfully so, and understandably so. And so we've worked to get other equity partners in place that to where we're not dependent necessarily only on retail investors. We want to be able to provide investment opportunities to people, because if it weren't for a passive investment, being an LP, I wouldn't have been able to start. But it doesn't we don't want it to be something that we're solely dependent on. And if we can't
Right.
end up raising the capital, then we can't get the deal moving forward. So that's something we've looked at, to looking at more institutional capital, you know, partners who have deeper pockets, who have partners who have deeper pockets, to where it becomes something that isn't going to make or break a deal, whether or not we can get the equity in place.
No, so I do want to touch on two very important points that you made, right? I mean, it's one that you've kind of pivoted a little bit away from, retail investors, right? Because a lot of retail investors, they may or may not necessarily listen to the news, the headlines and things like that, right? I mean, it's just doom and gloom every day on TV, newspapers, articles, right? Are you guys so? I guess two-part question, right? Right. Are you seeing a change in what they're requiring, right? Because they were always in play, right? They were always deploying capital. They were always wanting to make deals happen, right? Are you seeing a change in what they're requiring as far as deploying their capital?
The return
Their
criteria,
requirements. Yeah, that's right. Yeah,
whole, not really. No, and that's the thing. It does depend, because they're not just like retail investors and individuals. They're not all created equal. I mean, some they're looking at a 9 IRR, and others it has to be a 14. So it does vary. But they're a little more cautious and on a deal by deal basis, but then also they have raised funds and they do need to deploy the capital, or they have to send the capital back to their LPs, in which case they don't get an asset management fee and they don't get their 2 and 20 that they can end up taking. So that's something as well, right? Like they needed to deploy capital. So it's been, I guess, to answer your question directly, it's been a mix. Some people are kind of pulled back and are holding tight and kind of waiting and seeing in some respects, but then others are saying, well, we have this fund, like we have to end up deploying it because this is how we keep the lights on. This is our business.
just having that infrastructure and that kind of overhead, if you would, right? I mean, you gotta, to your point, keeping the lights on and needing to get capital deployed, right?
Mhm.
So kind of that second part of that question with, going back to the retail investors, are you guys finding yourselves that you're having to educate retail investors a lot more? And if so, I mean, what are some of the things that you guys are telling them? Hey, like sky is not falling. Maybe it is, right? I mean, if what is the messaging that you guys are giving your retail investors, right? To kind of keep moving forward. Because I mean, most of us investors, right, in the multifamily especially, we're not stopping, right? We're still looking at deals, we're still underwriting. What is that message that you guys are giving your retail investors to kind of keep them going?
The high teen IRR returns that have happened over the past, call it 5-ish years, give or take, that was a lot of capitalizing on good timing, right? So it was a lot of beta and not alpha, I would say. And generally speaking, real estate it's a way to build wealth, but to do so in a risk adjusted way. And so it's kind of reiterating the same messages around being able to be very highly recession resistant. Pre-recession, if we are in a recession, I don't know, that whole thing that's still going on.
That's right.
um, but yeah, it's letting them know people still need a place to live, right? If you're underwriting correctly, then you'll end up being fine. You don't want to end up putting risk on top of something that is a de-risked asset inherently. And so similar conversations that we were having before, Sam, but then providing more context around what's going on in the economy in general, and even being able to go back to other past 1, 2, 3 recessions and see, like, for instance, where occupancy has gone or economic occupancy has gone, and how the asset class as a whole performed during those times, and to say, like, we've been here before. This is
Right.
not something new, right?
But that's pretty important because most of us, most retail investors, all they see is the stock market, right, and how volatile it could be, especially during recession. It just super volatile, right, and it's everyone's felt it, right, one way or another, whether it's directly through your own, capital or otherwise. But just going back to the basics of real estate investing, and more so with multifamily, is it just adds another layer of de-risking that investment for our investors, which is like it's an amazing message to still kind of give out to everybody, right? Yeah, I do want to pivot a little bit. What kind of deals are getting done right now? What do you guys, so as you guys are looking, right? I mean, how are you making deals work, and what kind of deals are you guys seeing, whether it's yourselves or others around? What kind of deals are you guys getting done? Is generally kind of across the board, what kind of deals are getting done?
So to be clear, we haven't transacted in coming up on a year, right? And so our goal is 1 to 2 properties a year, like nothing too crazy.
Yep.
But what is getting done is there are distressed deals for sure. Like there was a deal recently where property management had been changed and occupancy was not great. And also their debt is coming due, like the term is coming due as well. So it's going to be a fire sale essentially. And so like those sorts of deals are getting done. There are distressed deals out there. The others are, it's it's flipped, right? It used to be a fair amount off market, but a lot that gets marketed. And now it seems like it's essentially, depending on who you talk to as a broker, it's a 90-10 or a 80-20 in terms of the vast majority is happening off market, because if there is a distressed deal, the seller doesn't want to put it on market and kind of expose themselves, because everybody finds out who's doing what and who everybody knows
Right.
who owns what. So it's kind of like trying to save face. And then as well, it'll end up moving quicker too if it does happen off market for the most part, just because there's not that whole marketing process. And so it seems like those are really the two that are truly getting done here. And that's what we've seen so far in the past, let's call it 6 to 9 months.
Yeah, and that's pretty that's interesting. I think that message is pretty consistent across the board, right? But I kind of want to tie it back to one of your original points of having those solid relationships with brokers, and when the times were good, those relationships that were built over the years, right? I mean, I feel like those relationships, they're going to be valuable now, and those that have those relationships and basically are ready to go, are going to be able to pick up deals, which is pretty important. Just continuing to build and strengthen those relationships, and just not take your foot off the accelerator, right? Just you got to keep going.
For
You can't
sure.
take yourself out of the game, because it's just getting back into it might be a little costly, if you would.
It's letting them know that we're still here, we're still around. And at the end of the day, right, it's an 80-20. There's a handful of brokers who are doing the types of deals that any of your listeners or yourself are interested in any given market. And so it's just nurturing and continuing to be communicative with those brokers, and if they bring you something, giving them feedback pretty quickly and letting them know where you're at, and those sorts of things.
Yeah. It's kind of another piece that I'm kind of seeing now is I'm getting calls. I wouldn't say constantly, but it is pretty regular, of folks just needing some capital, not going the extreme of, hey, I need to sell my asset. It's it's a crazy time. I need to get out, right? But it's like just patching up some of the holes in some of the previous assumptions, and being able to kind of continue to move forward, right? Are you seeing that on your end, as far as folks needing some capital, whether it's short term, or maybe just keep them going for another 6 to 12 months? Is that something you guys are seeing as well, or is it more kind of deal specific?
If I'm understanding your question right, are you saying like a broker's bringing a deal to you, and or is it
Yeah,
the
it would
G
be operators, right?
the
So
operator? Okay.
operators, they would be directly reaching out to, us investors, right? Or those that are needing capital, right?
Yeah.
Are you willing to come in? I just need a few bucks to kind of keep us going, right? Not necessarily a full on capital call, but just something to keep us going. I don't want to go and sell. I think it's still a great asset. We just need to get through this rough patch, right?
Deals where there are capital calls that are happening, which is, it's not great, but it's better than trying to do essentially a short sale or sell at a loss, right? So we've been reaching out to us about kind of coming in and helping to raise capital in a distressed deal. I mean, but that's the thing. Last year, there were other syndicators and it became very difficult to raise capital very quickly out of nowhere. And so there were a lot more calls that happened where there was a small shortfall, and it was a matter of the operators trying to figure out, okay, how do we end up filling this void, filling this gap. So we saw that a lot, and then there were deals that just kind of fell through because they just weren't able to raise all the capital as well.
Yeah. So yeah, interesting you mentioned that. So what's working now that wasn't working last year? Anything specific that you're seeing that's kind of like it's not as sticky anymore, right? We're going into 2023, hopefully.
Mm.
I don't know what it's going to end, and maybe I'll ask that question in a little bit. But what's working now that wasn't working last year?
Say I'll kind of give two answers. One is generally being able to actually underwrite to organic rent growth is pretty reasonable, right? You don't have to do anything too crazy. You can just end up essentially keeping up with baseline inflation or what inflation should be, 2-3-ish%, depending on where you're at and what market you're at. So I would say that that's a little bit easier. Last year and the year before, it was difficult, right? Even last year, there were deals that I would see, and they were looking at like 7% growth for a couple of years out, and it was here in Austin, but I'm like, where are you getting this number from? Like, is this the sky? Are you pulling it out of somewhere? Like, I don't know. So the other thing that's worked well for us as a business, for my wife and I, for Daisy and I, is literally just being more focused. Like, we've narrowed down significantly in terms of what we're spending our time and resources on. Part of that is I didn't mention this, but we had a son in July. So he's like a little bit over 8 months now. And like that forced us to thank you. Yeah. And that like anybody knows who's become a parent, like that'll force you to get very focused very quickly on terms of what you're spending your time on and where you're putting it. And so that's actually been a large, I'd say a big benefit to us for to have our son, just because now it's like, does this make sense? Does it not? Okay, are we doing this? Are we not? And it becomes very clear cut. There's no kind of like in between. Okay, we'll try it out. We'll do it a little bit and see what happens. It's like, no, there's none of that anymore.
Yeah, I can attest to the 1 foot in, 1 foot out, right? I mean, I did that for a couple of years, and I'm telling you, it didn't work for me, right? And it was just my focus needed to be on one thing 100% of the time, and it's like I'm glad you mentioned that, and it's pretty amazing to hear. You have similar, you guys are on similar path, and that's pretty cool, man. That's awesome.
I appreciate it.
Yeah, and maybe we do another episode. I'd love to get your take on you and your spouse and some of the things that you guys do and don't do well, right? It's like I feel like it's a whole new topic on its own. I could talk hours, days on that as well.
Like,
So
she does everything well, and she's always right, and I just end up filling in. I just get in where I fit in, and that's how it
that's
works.
that's that's the closest thing to the truth. And if anyone says otherwise, I'd like to talk to them. Come on. All right. All right. Last question, and it might be a little loaded question, but what's your prediction? Right. I mean, we're like you said, we're in spring of 2023, end of Q1 2023. Right. We got all this news we've had in the past and current. Right. I mean, the interest rates just got raised again. Right. Just what are you seeing in the near future, whether it's 2023 and maybe even 2024 and beyond? What are you guys kind of banking on, if you would? What's the prediction?
Because so much of what's happened has just been motivated by what the Fed is doing. I think that I don't know how much they're going to raise. I mean, I don't have a crystal ball or anything like that. I think that they'll continue to raise to a certain degree, but I think that rates are going to stay elevated longer than they need to be. And then once they decrease rates, like they're going to fall off a cliff. And I'm literally I'm engineer by training. Like, I'm just going off of what's happened before. I just look at the chart over time. And that's what it seems
Right.
like that's what happens every single time. They just kind of keep them elevated and then they drop off a cliff because they're like, oh crap, we're in a recession.
Overcompensate. Yeah.
Yeah, pretty much. It's like you're driving on a road. It's like, okay, let's do that. Okay, let's do that. And let's
That's
go
what it
left.
seems like. I feel like it's but yeah, sorry, go ahead.
Yeah, I think that that'll probably end up happening just because that seems like what the MO has been. But then I guess we have to navigate all these short term things that are happening. But I mean, long term, 10 years from now, we'll end up looking back and think, okay, it was good that we got into this specific deal because we ended up being able to build this much in value and equity and create this much wealth, right? Like that's long term where our head is going as well. Like there are these short term things that are happening, but we will end up entering like a true recession. We will end up getting out of it, and then we'll do this all over again. And it'll happen in another 7, 10, 14 years, whatever it is.
That's right. Yeah, that's right. I mean, it's that short term thinking and those short term gains. I mean, this is not the game, right? I mean, it's it worked in the past couple of years, maybe, right, for some deals and some operators, and that's great, right? I mean, we definitely those who took advantage of it, it was great, but real estate in general it is a long term game, and you just got to stay in it, stay active, make sure that you're consistently looking at deals, looking for deals, and man, you guys are doing amazing. I can't wait to hear more about what you guys are doing, and I'll definitely connect with you offline and talk about some deal specific stuff as well. So, any closing comments? What are you guys working on right now? Anything interesting, fun?
As it relates to real estate, we're continuing to have conversations with partners that can help place a solid amount of capital. So that way we can do deals where the economies of scale are there. So I mean, that's one thing. And then continuing to end up looking for deals as well. Like we're still touring, we're still underwriting, like we haven't stopped. So that's something that's continuing on, of course, because we need to kind of keep a pulse on what's going on and then make sure that the brokers know that we're still involved. So on the real estate side, that's fun and interesting. On the life side, I mean, geez, like having a baby, like it's like
That's there, man.
yeah, it's like there's always something new that's going on. Yeah, he's great. It's great being a father, and other parents have told me this. It's like, oh, just when you think things are going steady, then something changes, and it's like, yeah, inevitably that does end up happening. But that also means that he's growing too, so it's a good thing.
Love that. Dude, that's amazing. I'm super happy for you guys. All right. I do want to get our listeners. What's the best way to get in touch with you? Whether it's phone, email, social media, whatever. Just some ways for everybody to get in touch with you.
To go to our website, it's makeitraincapital.com. Our emails and phone numbers and contact info and social media are all on there, but that's kind of the repository, and our podcast is on there too. Like kind of everything about us as far as Make It Rain's concerned is on there, but yeah, it's just makeitraincapital.com, and that's where everything's at.
Awesome, man. I really appreciate your time. I'm gonna make it my goal to maybe have you guys back in California. I don't know if that's gonna happen or not, but let's see. I'm gonna make it my own challenge, if you would. But
Yeah, we'll see what happens. I mean, my wife has kind of hinted or thought or talked about it like years in the future. But yeah, we came out here for like very specific reason, very specific goals. And so if we hit those, then
yeah,
we'll see what happens. Yeah, the future is always in motion.
that's awesome, man. Yeah, we came out to scout the market as well. It just didn't end up doing it, but maybe it's worth another try. Yeah, awesome, man. Again, appreciate your time, and yeah, we'll be talking soon, I'm sure.
And best of luck on the continued success with the podcast.
Thank you. Thanks, brother.
Yeah, see you.
Take care. All right. Thanks for watching today's episode of the True Wealth Project, and I hope you enjoyed today's guest as well. If you want to catch more of these episodes, be sure to like and subscribe us on YouTube, as well as other podcast platforms. You can also get in touch with me by following me on Instagram at official Sam Khairi, or you can send me an email at sam@aftocapital.com. That's sam@aftocapital.com. See you soon.